I think consumers are experiencing this very, very high inflation, and I think that's really clouding their confidence in the economy. You know, at the Fed, we're on a path now to bring our interest rates up to a more normal level and then probably a little bit higher into restrictive territory so that we can get those inflation rates down so that we can sustain a good economy going forward. So job one for us now is to get inflation under control. And I think right now that's coloring how consumers are feeling about the economy and where it's going.
So many, like decision makers, CEOs, do use the word recession very often these days. Would you say that risk of a recession has increased for the U.S. or that the U.S. already is in a recession?
Well, there's certainly a lot of uncertainty about what the path forward is. And I would say that there are risks of recession. We're tightening monetary policy. We have to do that to get inflation down, so there are risks. My baseline forecast is for growth to be slower this year than it was certainly last year, where it was 5.5%, which is extremely high. And we're going to see some slower growth this year, but that's okay because that's what we're trying to do. We're trying to get demand moderated so that it's more in line with that constrained supply. And so I do expect growth to be slower this year than last year, you know, in the a little bit below trend growth, which I put at 2%, and then also I expect to see unemployment rates rise over the next 2 years to a little above 4% or 4.25%. And again, that's still very good labor market conditions. So we're in this transition right now, and I think that's going to be a painful one in some respects, and it's going to be a bumpy ride in some respects, but it's very necessary that we do it to get those inflation numbers down.
Yeah, this so-called soft landing is kind of a difficult task to achieve. How likely do you think you'll achieve that?
Well, I see paths towards it. I mean, I think there's a lot of uncertainty out there. There are other shocks that are beyond the control of monetary policy. And as we go forward in the year, as we're bringing those interest rates up and we want to get to a neutral rate or a more normal rate by the end of the year, which I would like to see us, you know, between 3 and 3.5% by the end of this year and a little bit above 4 over the first half of next year. I think that's going to be sort of the assessment of how fast is demand moderating versus do we get some help on the supply side? Do we have people coming back into the workforce? Do we have the supply constraints that we've seen in those disruptions in the supply chains alleviate somewhat? And so we're going to see both supply conditions change as we go further, and we're going to see demand conditions moderate. And it's that assessment that's going to drive what monetary policy needs to do to get inflation back down.
Yeah, let's look at the concrete next steps. Would you advocate a 75 basis points hike or rate hike also in July?
So, you know, the July meeting, it's still going to be a debate, I think, about 50 or 75. We still have a couple weeks to go to look at the data. If conditions were exactly the way they were today, going into that meeting, like if the meeting were today, I would be advocating 75 because I haven't seen the kind of numbers on the inflation side that I need to see in order to, you know, think that we can go back to a 50 increase. So I think right now I would be advocating 75, but again, we don't have to make that decision today. We still have a couple weeks to go. I think getting interest rates up to that 3 to 3.5% is really important that we do that and do it expeditiously and do it consistently as we go forward. So it's after that point where I think there's more uncertainty about how far we'll need to go in order to rein in inflation.
Yeah, I mean, there's some parts of the markets that are already speculating that you actually have to cut rates again early next year. Would you say that's exaggerated?
Well, I don't see that in my baseline, but again, you know, we're going to just have to assess economic conditions on the ground as we go forward. Again, it's really about what's the speed at which demand is moderating, what's the speed at which perhaps some of the supply constraints are easing, and it's that balance between the two that we need to get to so that price pressures get reined in and get back to a more normal inflation rate.
What are the implications for the real estate markets? Because we have seen mortgage applications also slumping, and it's so important also for the U.S. consumer.
Well, you know, one of the mechanisms when we raise interest rates is we do expect to see some slowdown in those very interest rate sensitive sectors, and housing, of course, is one of those. The housing market has been extremely strong. Mortgage rates have been low, but as we've begun to tighten rates, you're right, mortgage rates have gone up, and we're starting to see some slowdown there. But again, we're looking for some moderation in those sectors in order to relieve price pressures.
Where do you see actually the worst bubbles perhaps in the economy which could be affected by the rate hiking cycle?
Well, the markets have moved, and the volatility in the markets probably is here to stay. Certain days, it's moving up, certain days it's moving down. But again, I think what's important is that we're on a path of bringing our interest rate up to a more normal level, and that's the mechanism through which we're going to do what we can on our side to moderate demand. Again, lots of other things are affecting inflation now that are beyond our control, but we have to do our part.
You've said earlier in our interview that you have not seen inflation moderating, of course. Where do you see peak inflation and when, perhaps?
Yeah, well, I do expect inflation to moderate a bit, but we haven't seen those numbers. So I need to see consistent, monthly changes that are first stabilizing and then moving back down, and we haven't really seen that yet. So I think inflation from here could go up a little bit from where we are, but I do expect that our interest rate policy, as we move that path of interest rates, continue on that upward path, inflation will moderate. I don't think it'll be near 2%, certainly this year, and probably moving down over the second half of next year to still being above 2% by the end of the year, but well on its way.
Yeah, the ECB is expecting inflation to be back to target in 2024. What are you expecting for the U.S. economy?
Yeah, I think we'll be well on our way next year. So I think in my SEP, I penned in like a 2.5% to 2.75% by the end of next year. But really, that's good in the sense that it'll be obvious that inflation is moving back down, and then also I have inflation then taking after that, the year after that, to come back to 2%. So again, it is a process. We're just at the beginning of the rate rises, really, but we've got to be consistent and intentional in order to rein in those price pressures and get inflation back down towards our goal.
The Bank of International Settlement just recently said it's probably the worst situation since the Second World War we are in, if we're looking at all the uncertainties, all the risks. So how would you characterize the current environment?
Well, it is very uncertain. We've had things over the last couple of years that no one could fathom, and they weren't economic shocks, right? We had the pandemic shock, and then the shutdown of the economy, and then the reopening of the economy affected demand and supply and those imbalances. So it's a very uncertain. Then we have the invasion of Ukraine by Russia. So again, these are uncertain, non-economic things that have economic implications, and so that adds to the uncertainty as opposed to a regular kind of downturn or upturn in the economy, and so it makes it more complicated.
Yeah, it seems that we're in the middle of kind of a reshuffling of how the world economy is actually organized. Would you say that you see also changes, lasting changes in the economic structure?
Well, I think we're going to see, and we're going to learn over time, what the lasting changes are. Just think about the way people work now. It's very different than pre-pandemic. Where will that be? How will that settle out? I think there's a lot of things that are kind of exciting that potentially could be very positive for the economy. But again, it's hard to assess that now.
So what would be the exciting factors which would be positive for the economy? Is it much more flexibility in the working space?
Flexibility, productivity changes, if we could really, garner, right, all the things that we've learned about working remotely and digitalization. There are exciting things that could be very positive for the economy. But again, right now, right, we're in a world of uncertainty. We know inflation is way too high. We know it's very painful for people and for businesses, and we're on the job of bringing those rates up to get inflation back down to 2%.
Yeah, the U.S. economy is known to be much more flexible than the Eurozone economy, so wages are picking up as well. So is that a problem that we could see second-round effects actually hampering that you're getting back to your inflation goal? Well,
right now, the labor market is incredibly tight in the U.S. If you look at job offers or job openings, it's twice as high as the number of unemployed. So that's a very, very tight labor market, and unemployment rates are very low. So again, yes, we've seen wages go up. Some of that is just a reevaluation of where wages should be, the market wage for some of those lower wage jobs. But again, we're trying to make sure that we don't allow inflation expectations to move up too high, because that's how you get things embedded in the economy. We're not in a wage price spiral at the moment, but it's really important for us to make sure that our monetary policy doesn't allow that to happen and doesn't allow inflation to get embedded in the economy. And that's what we're about right now in terms of what we're trying to do.
Just one last word on stagflation, because clearly that's also something which is widely discussed. So is there a risk?
Well, we're going to be in a lower growth environment as we go through this transition back to 2% inflation. I think beyond that, we're going to be able to have a healthy economy, both healthy labor market conditions and also growth that's moving back towards trend. That transition path, over the next year or so, that's where it's going to feel like, well, growth is below potential. But I don't have a baseline case that we're going to be in a recession, and we're just have to monitor, how fast is demand slowing versus how much is supply changing. And as we go forward, that's part of the work that we'll be doing when we set monetary policy.